Hi there, this is Sandra with the Mortgage Center. Quick update for members of GDAR and any realtor who's watching this. GDAR, of course, is the Guelph and District Association of Realtors, and the Mortgage Center loves being a platinum sponsor for you guys because we love working with realtors. So you probably know that the Bank of Canada increased its overnight lending rate yesterday by 0.5%. However, most of the mortgage prime rates have gone up by 0.25%. So mortgage prime rate is impacted by the Bank of Canada's overnight lending rate, but they normally travel in tandem. But again, in this case, the Bank of Canada increased the rate by 0.5%. The mortgage prime rates went up 0.25%. So today, the mortgage prime rates for most financial institutions, there are some outliers, is 2.7%. And clients right now on a variable rate mortgage are generally getting prime minus 1%. So that's the discount off of the prime rate. So prime rate today is 2.7 minus 1%, 1.7%. Okay. Fixed rate mortgages have actually already gone up. And so right now on a 5-year fixed rate, most people are paying about 3.25. Some are a little bit higher, some are a little bit lower. So it's interesting. I did check the Bank of Canada 5-year bond yield. So that influences fixed rate mortgages. And the bond yields have spiked, but they're coming down. And I've included a link below just so you can see what's happening with the bond yield. So we actually think that the 5-year fixed rates might come down in the next couple of weeks. So you have to understand what's happening. Just because the Bank of Canada increases its rates, it doesn't necessarily mean that that's going to impact fixed rate mortgages. So fixed rates have already gone up, but the bond yield is trending down. So we may see fixed rates coming down. You don't need to know all the gory details. Leave that up to us. Whenever we have a conversation with the client, obviously we're going through the different scenarios and helping clients make good decisions. But here's some advice for you as a realtor. And people who have been pre-approved for a mortgage. It doesn't matter if they're first-time home buyers or if they're buying and selling. So most pre-approvals are good for 120 days. It's a rate hold period. However, people usually take somewhere between 9 and 11 months to actually buy a house. So you may want to have your buyers check their rate hold period to see when that expires. Okay, it doesn't necessarily mean that the pre-approval is expired if nothing has changed from an employment or credit perspective. The other thing is that the qualifying rate has not changed. So you know that there's a stress test rate for people to qualify under. That has remained 5.25, and I think that has been like that for at least a year to year and a half. So the amount that people qualify for hasn't changed. However, your buyers may want to check in and see when their pre-approval rate hold period expires. Some financial institutions lock it in for 60 days, 90 days, 120 days. Okay. And then for people who are buying new construction, there are 12-month rate hold periods, but those mortgages need to be insured against default. So the person is paying a premium. And what I tell our clients, if you can't sleep at night, don't choose a variable rate mortgage. But if you think about it, right now the 5-year fixed rate is at about 3.25. Variable is at 1.7. So even if rates do go up, and we know that they will by 1.5%, possibly within the next year to 2 years, you're still better off with a variable rate mortgage. But if you can't sleep at night, don't go with a variable rate mortgage. I personally have a variable rate mortgage, and I would say maybe 50% of our clients have that. So this is just some really great information for you. You know, we are always available to chat with you or your clients. To schedule an appointment, you can click on the link below or go to my website at skipthebank.ca. And thank you so much for allowing us to be a part of the platinum sponsor for Guelph and District Association of Realtors.